The biggest risk in financial markets today isn't a recession. It isn't inflation. It isn't China. And surprisingly, it might not even be artificial intelligence. It's Elon Musk. Now, before you click off and accuse me of becoming a professional Twitter addict, hear me out, because this isn't really a story about Elon Musk. It's a story about concentration. It's a story about dependency. And it's a story about how millions of ordinary investors are making one of the largest financial bets in history without even realizing they're making it. Because if you have a retirement account, an index fund, or pretty much any investment portfolio built during the last decade, there's a good chance you're already exposed to Elon Musk, and that exposure is becoming larger every single year. In fact, the financial system has become so dependent on Elon Musk-related companies that one person now has the ability to influence trillions of dollars in market value. And the craziest part? Most people don't even realize it's happening. Because when people think about Elon Musk, they usually think about cars, or rockets, or occasionally posting things online at 3 in the morning that make public relations departments around the world spontaneously combust. But that's not what makes Elon Musk important. What makes Elon Musk important is that he sits at the center of some of the most valuable narratives in modern finance: electric vehicles, artificial intelligence, autonomous driving, space exploration, satellite communications, and increasingly national infrastructure. It's almost impossible to find a major future-facing investment theme that doesn't somehow lead back to Elon Musk. And that's where things start getting interesting, because markets don't actually buy companies, markets buy stories. And for the last decade, investors have been buying one story more aggressively than almost any other: the story that Elon Musk is building the future. Now, whether you believe that story is completely true, partially true, or complete nonsense doesn't really matter, because financial markets don't operate on certainty. They operate on expectations, and expectations are incredibly powerful. Just look at Tesla. Today, Tesla isn't valued like a car company. If investors valued Tesla like a traditional automaker, its market capitalization would look dramatically different. Instead, investors value Tesla as a robotics company, an AI company, an autonomous driving company, an energy company, and sometimes a company that's going to solve every problem known to humanity. Tesla has become something much larger than a business. It's become a financial narrative, and narratives attract capital. Lots of it. But here's where the story takes a turn. Because the more successful Tesla became, the more deeply embedded it became inside the financial system itself. And once that happened, Elon Musk stopped being just a CEO. He became a systemic factor. Now that's a boring finance term. So let me explain. Imagine you own a small coffee shop. If your coffee shop has a bad year, it affects you. Maybe your employees, maybe your suppliers, but that's about it. Now imagine you're responsible for an entire city's water supply. If something goes wrong, everyone notices. That's the difference between being important and being systemic. And Elon Musk's companies are increasingly becoming systemic. The reason starts with something called passive investing, which sounds boring, but it quietly changed the entire market. Years ago, most investors actively picked stocks. Today, many investors simply buy the index. And that's where things get interesting. Because index funds don't think, they don't ask questions, they don't evaluate narratives, they simply follow rules. And one of the most important rules is size. The bigger a company becomes, the larger its weight inside the index. And the larger its weight inside the index, the more money automatically flows toward it. Regardless of valuation, regardless of sentiment, regardless of headlines, the machine keeps buying, and Tesla became one of the biggest beneficiaries. Now here's the part most investors never see. When you buy an S&P 500 index fund, you aren't buying 500 equal companies, you're buying a weighted portfolio. And the largest companies dominate. That's why concentration matters, because when one company becomes large enough, it stops being just another stock. It starts influencing the index itself, and that means it starts influencing everyone. Retirement accounts, pension funds, ETFs, mutual funds, and increasingly, the broader financial system. This creates a powerful feedback loop. The stock rises, it gains more index weight, and then more money automatically buys it. And that's where the story expands beyond Tesla. Because Tesla isn't the only company investors are betting on. There's also SpaceX, the most valuable private company on Earth. And unlike Tesla, most investors can't directly buy it. At least not yet. And that's exactly why the IPO conversation matters, because when a company enters public markets, it suddenly becomes accessible to everyone. Index funds, retirement accounts, ETFs, and potentially hundreds of billions in new capital, which sounds exciting, but excitement and valuation aren't the same thing, and markets often confuse the two. History is full of examples, which brings us to the real question. What happens when narratives become too big? Because that's usually where the trouble begins. Investors stop valuing what exists. They start valuing what they hope exists. And hope can be very expensive. Just look at artificial intelligence. AI is real. AI is useful. And AI will probably transform entire industries. But that doesn't automatically justify every valuation. And that's the mistake investors repeatedly make. They confuse a great product with a great investment. And those aren't always the same thing. That's where XAI enters the story. Because XAI isn't being valued like a startup. It's being valued like the future. And that's a dangerous difference, because future expectations can change very quickly. And when expectations change, valuations usually follow. And history gives us plenty of examples. The dot-com bubble, the housing bubble, the Nifty 50. The names change, but the psychology stays remarkably similar. Everyone believes this time is different, until it isn't. Now, to be clear, I'm not saying Elon Musk's companies will fail. They might succeed spectacularly. They might exceed expectations. They might change the world. The problem isn't innovation. The problem is concentration, because concentration creates fragility, and fragility creates risk, especially when everyone owns the same thing. Without realizing it, that's how systemic risk is created. And that's why this story matters. Not because of Elon Musk, not because of Tesla, not because of SpaceX, but because of incentives. Because incentives shape capital flows, and capital flows shape markets, and markets shape economies, and economies shape lives. So this isn't just a finance story. It's a story about risk. It's a story about incentives. And it's a story about attention. Because the biggest risks are rarely the loudest. They're usually hiding in plain sight. And that's exactly why investors miss them. So pay attention. Question assumptions. And always follow the money. Because in finance, the most important stories are usually the ones nobody is talking about.